Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to have you join me today as we explore some of the most pressing issues in the financial landscape. We're starting off with a story that's been making waves in the investment community: Warren Buffett's significant stake in Occidental Petroleum. The billionaire investors company, Berkshire Hathaway, has invested heavily in the oil and gas giant, but with oil prices struggling to stay above $60 per barrel, many are wondering if this bet will pay off. Now, it's no secret that Buffett has had a mixed record when it comes to investing in the energy sector. In 2008, his stake in ConocoPhillips took a hit during the financial crisis, and he later exited ExxonMobil in 2014 after oil prices plummeted. However, with Occidental Petroleum, Buffett seems to be taking a different approach. In 2019, Berkshire Hathaway invested $10 billion in preferred stock to help fund Occidental's acquisition of Anadarko Petroleum. And just last year, the company purchased Permian driller CrownRock for $11 billion, further increasing its debt burden. But despite these challenges, Occidental's recent financial performance has shown some promising signs. In their first quarter earnings report, the company announced better-than-expected results, driven by strong production and improving natural gas prices. They also generated $3 billion in operating cash flow and $1.2 billion in free cash flow after capital expenditures, which they used to pay down debt and increase their dividend. So, what does this mean for Berkshire Hathaway's stake in Occidental Petroleum? Will Buffett continue to hold on to his investment, or will he look to adjust his strategy in response to the current market conditions? These are questions that we'll be exploring in more depth as we continue to follow this story. As always, our goal here on the Riskwiser Zone is to provide you with a balanced and informed perspective on the world of finance. We'll be keeping a close eye on developments in the energy sector and their potential impact on investors like Berkshire Hathaway. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the latest developments in global trade, and now it's time to dive into a significant agreement that could have far-reaching implications. The India-UK Free Trade Agreement has been making headlines, and we're here to break down what it means for businesses, investors, and consumers alike. According to recent reports, the agreement grants zero-duty access to 99% of India's exports to the UK, which is a substantial move that could bolster India's position in global trade. This development is expected to facilitate greater levels of trade between the two nations, potentially making up for shortfalls resulting from U.S. tariffs. We spoke with experts who believe that sectors such as logistics, infrastructure, green energy, and retail are best poised to benefit from this deeper collaboration. The reduction in customs duties on premium vehicles could also drive meaningful demand for UK-based luxury auto brands in India. Additionally, the halving of the 150% import duty on Scotch and gin might be a turning point for premium spirits in the Indian market. It's essential to consider the potential impact on private capital mobility between India and the UK. The agreement sends a strong signal to the market about the intentions of both nations, giving businesses, individuals, and investors confidence in moving into the Indian market. This could lead to increased inbound and outbound M&A activity, as greater confidence and stability tend to boost appetite for deals. As we analyze this development, it's crucial to maintain a balanced perspective. While there are potential benefits, it's also important to consider any challenges or uncertainties that may arise. The agreement's effects on the global economy, trade relationships, and individual industries will be closely watched in the coming months. As we continue to navigate the complexities of global trade, it's essential to stay informed and adapt to changing circumstances. We'll keep a close eye on the developments surrounding the India-UK Free Trade Agreement and provide you with timely updates and insights. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to bring your attention to a story that highlights the unintended consequences of trade policies on small businesses. You may have heard about President Trump's tariffs and their impact on the global economy, but let's take a closer look at how they're affecting entrepreneurs right here in the United States. A recent report by CBS Sunday Morning sheds light on the struggles of small business owners like Beth Bennick, who was named Minnesota's Small Business Person of the Year. Her company, Busy Baby, manufactures products that are now subject to tariffs, which have increased her costs and put her business at risk. In fact, she's worried that she might lose her house due to the financial strain. Now, I know some of you might be thinking, but Louis, isn't this just a matter of patriotic duty? Shouldn't we be supporting American manufacturing? And I get that. However, as economic analyst Kyla Scanlon points out, broad and blanket tariffs can be detrimental to small businesses that don't have the resources to adapt. Scanlon suggests that targeted tariffs might be a better approach, but the current situation is causing uncertainty and confusion among entrepreneurs. As she puts it, when small businesses don't know how to invest, they don't know what they should be spending money on. It's just not a good economic environment. It's essential to consider the human side of these policies. Bennick, who served in the military, is now facing an uphill battle to keep her business afloat. She's having to improvise and adapt, exploring alternative markets and strategies to stay ahead. As investors, we need to be aware of the potential risks and opportunities arising from these trade policies. It's crucial to stay informed and consider multiple perspectives before making any investment decisions. So, what can we take away from this story? Firstly, it's essential to be mindful of the impact of trade policies on small businesses and the broader economy. Secondly, diversification is key. Spreading your investments across different asset classes and industries can help mitigate risks. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.